Hey everyone, I'm super excited today because I'm going to be sharing with you a strategy called a put ratio spread, and I'm going to be breaking it down step by step because I think that today's environment where we have these massive swings up and down is the perfect time for these types of trades. And with the high IV that is out there right now in the market, trades like this can net me like 1% a week, 2% a week. Now think about that for a second. If I could make 2% a week on a trade, I could literally double my account in a single year. It's a very, very simple strategy. It's quite similar to trading a naked put or a cash secured put. And I think that it's very important for traders to understand the mechanics of how it works. And that's what we're going to cover today. Hey everyone, welcome back. My name is Levi Woods. This is Drawbridge Finance. And as always, I'm not a professional investor. I don't work in the finance industry and I don't offer financial advice of any type. But I am a longtime trader. I've been trading options now for like 8 years, and it's been a wonderful, wonderful ride. And I have a ton of people in my community, and we trade options all the time. And the fun thing about being an options trader is that I can dictate what types of trades I put on at different times. And one of the trades that I've been doing quite substantially in the last couple of weeks is something called a put ratio spread. And the reason for that is because of the extra volatility that we have in the market. Now there's 4 key components to a put ratio spread. Now we want to enter them when the implied volatility is high. What does that mean? When the stock has been moving around a bunch, this is generally a good time to sell premium or to sell puts, which is the core of this strategy. The second thing that we want to understand about a put ratio spread is that it's a bullish strategy. It makes money when the stock goes up. But it has a little bit of a twist to it. It actually has an added bonus that we have a slightly lower break even, so there's a bit more safety and therefore a higher probability of profit. And there's a potential for it to actually make more money than the initial credit collected, which is pretty amazing in itself. Now, when I trade put ratio spreads, I often do them for a credit, and that's very, very important. I have to make enough money at the outset of the trade that I'm happy with the result if the stock doesn't move at all, if it just stays exactly where it is, because my assumption always is that there's a potential the stock is just going to trade flat. It might trade down, it might trade up, but I want to make money if it doesn't move at all. And that is very, very key. Now, one of the other things about a put ratio spread is that I want, generally speaking, to open them on a down day. So when the stock market is moving down, put option premium generally is jacked up. So that means I'm getting more money on the outset of the trade, which therefore means I'm potentially going to make more money if I'm correct and the stock either stays where it is or moves upward in direction. So it's very, very important, generally speaking, to open on a down day. Now, I'm actually going to show you a trade where I did the exact opposite. On a trade on Disney where Disney was going up in value, and I put in a put ratio spread because I thought that Disney would either continue to go up in value, or if it did drop, it wouldn't drop too much. And that is what we're going to go over today. I'm going to jump right into the details of this trade, and you can see that I entered this trade when Disney was trading at $147 on February 9th. I put in a put ratio spread and I collected $89. I'll show you what the profit chart looked like here. You can see at the end of the week, I made $87 profit, or a 2.3% return. And this was in a single day. I only held this from February 9th to February 10th. It's pretty amazing. I want to show you the overall setup of what I'm actually looking at. On February 9th, the stock was trading up here at $147. It was up 3.29% that day. What I was thinking based on this chart, you can see that the stock had been moving up quite substantially. This is not a good time to be entering a put ratio spread. But it was an earnings announcement. And because of that, the IV rank was extremely high. You can see here that this February 11th date actually had an IV of 118%. This is extremely high, and this is why I placed this trade. And what I wanted to do was to make some money if the stock went either up, sideways, or down. And you can see on here, I've actually marked the break even. So the break even on this trade was $132.11. So as long as the stock stayed above $132.11, I would make some money on this trade. But there's a little twist because this isn't just like selling a put, which is really simple. First of all, we'll start with the put. And now in this case, I was being very, very aggressive. I was looking at this 25 delta. By using a 25 delta, I'm saying that there's a 25% chance that the stock could go down below this 138 mark. Because of the nature of the trade, I wanted to take that risk. I actually was thinking, well, there's a 25% chance that it could go down to this price. If I'm correct about that, then I could make a lot of money. And if I'm wrong, it could go down. So the key component here is this 138. Now, if I was just selling a put straight up by itself, I probably wouldn't have gone quite so aggressive. I probably would have been trading somewhere closer to the 16 delta and selling the 133 put. The reason that I did this is because there's a potential that we can make even more money. If you look at the profit loss chart, you can see that there's this incredibly large profit hump. To enter this trade in my brokerage is extremely simple. There's a total of 3 puts. 2 of them I'm selling at the same strike of 138, and they are out of the money, which means they are lower than the current price of the stock. I'm also purchasing another out of the money option at a higher strike. And the width between the short strikes and the long strike are very important. In this case, it's $5 or $500. Now, I'm going to show you in my software because it's a little bit easier than looking at it in my brokerage platform. So let's take a look at a couple of different scenarios. I'm going to go down to this trade comparison tab. I've got it set up already, but these are very straightforward to fill out. We put in the stock, Disney. In this case, I've backdated it, but normally the date just shows whatever the date it is that we're making the trade. Put in the current share price, and then I can actually compare different strategies. From the pull down, let's look at a naked put, a put ratio spread, and a put spread. And then we can compare those graphically and see what kind of money we can make right in the chart. I'm going to compare February 11th and February 11th expiration dates, selling a 138 put and collecting $235. Both a naked put and a put ratio spread are open for a credit. There's single contract, so the total premium collected is $235. The max risk on this trade is $13,565, which sounds massive. It's like, wow, you're trying to make $200 and you're risking $13,000. Well, the reality is, in order for me to lose $13,000, Disney would have to go to zero. $0. Disney, $0 the share. So am I really risking $13,000? Not really. But there is a very important variation that you can do to a put ratio spread, which is called a broken wing butterfly. Now, if you're not familiar with that term, it's a way smaller capital requirement. It has very, very similar properties to the put ratio spread that I'm showing you today. So if you're trading in a small account, you should definitely click subscribe, because I'm going to be doing a video on that very, very soon on how I trade broken wing butterflies. Now, I did 2 broken wing butterflies this week that returned over 10%. I'm doing a little challenge right now with my patrons where we're doing an 11% challenge every single week with a $1,000 account. In the last 5 weeks, 3 times we've been successful. We beat our goal of making over 11% per week. It's pretty great. And the goal with that challenge is to take $1,000 and go to 100,000. It's going to be a fun, wild ride. Right now it's for patrons only. When I do hit 100,000 subscribers, I'm going to be opening up that trade scenario publicly. So if you are thinking, well, why I want to get in on this, and you don't want to become a patron right now, feel free to share my website out with people and get more people to come and check me out, because when I hit that 100,000 subscriber goal, I'm going to be releasing this 100K challenge completely public, which is going to be amazing. Now, enough of that. Let's get back to this trade, the put ratio spread. So in this case, it is a fairly high margin trade, but it can make a massive amount of money and relatively safely. So the blue line is the naked put, and you can see how much money that it is making. The green line represents where the stock is right now at 147. And if the stock stayed where it was, I would make $235. Compared to that to the put ratio spread, it's only going to make about $89. But the trade-off is this break-even point. The break-even of the put ratio spread is way down here at 132.11, and the break-even on the naked put is at 135.65. That is where this trade can excel, because if we're in a position where the stock sells down, I could actually potentially make up to $589 on the put ratio spread. Whereas on the put, I can only make a maximum of $235. This does not mean that I'm betting that it's going down. I have to be happy with how much money I'm getting. Is the $89 an appropriate amount of money based on the return? If you're basing the trade on cash secured value, this is returning around 0.67%, which is pretty good. I mean, for a 2-day trade, if you made one of these trades every single week, you would make almost a 50% return annually, which is pretty amazing. And we can see that the stock would have to drop from $147 a share down to $132 before we lost money on it. Now, the beauty is that if it drops down slightly into this range, I could make $500 here. So I actually have a little bit of a bet on the side. I'm okay with buying the stocks and I'm feeling pretty safe about it, but I could potentially make more money. Now, why does this work? That's really the key. That's what we want to understand. So to show you exactly how it works, I'm just going to put in a bear put debit spread. And what this is it's a put spread that will make money if the stock goes down. And the reason that I would want to do that is because I can do it when I pair it with a naked put for a net credit. So I'll show you, if I entered it by itself, if I put this in comparison 3, here's a put spread. So what I'm doing is I'm buying a 143 strike and I'm selling a 138 put. These are both puts, and I'm paying a debit of $146. Now, by itself, that doesn't really make a lot of sense because you can see if the stock didn't move or if the stock went up, I would actually lose money. I would lose this $146. You're thinking, well, that doesn't make a lot of sense. What I'm doing is actually combining 2 trades. I'm selling a naked put for $235 credit, and I'm also purchasing a bear put spread for $146 at the same time. So by selling 2 puts and buying 1 put, I'm opening this for a net credit of $89. And you can see what happens with the bear spread is that if the stock goes down, then this bear spread, this yellow line, actually makes money. It actually makes $350. And that's why these two combined work together. So because I've opened it for a net credit of $89, then that's what gives me this line here, which means that it doesn't matter how far up the stock goes, I'm going to make at least $89. Now, I said before that this is a bullish trade, and I want to just scroll down on my comparison and show you, because if you look at these different charts, you can see the green highlight. Let's just say that the stock went down to $126. Well, it's pretty clear to see that the debit put spread is actually a bearish trade. It makes $354 by itself. Now, the put ratio spread, on the other hand, would actually lose money. If Disney went down to 126, I would lose $594. And subsequently, the naked put, I would actually lose even more, $948. It's very important to understand the risks on this, because if there is a massive drawdown, a naked put or a put ratio spread can actually lose a lot of money. On the flip side, there's this kind of sweet spot in here where if we compare around the 136 mark, you'd only make $100 on the naked put, but you could make $456 with the put ratio spread. This tab that I'm showing you today with these 4 comparison columns is actually part of my rolling options record keeper. If you go over to my website and you click on the spreadsheets, go to options spreadsheets. Now, what happens if the stock goes down? I want to show you another little trade, and this one's very, very, very similar. It was on PayPal. I entered it on February 2nd when the stock was trading at $131, and it had an expiration date of February 4th. So this was another 2-day trade, and after only 1 day, I was actually able to close this for a massive return. My expectation was that the stock was going to stay where it was and hopefully go up. I was going to make $100 on that case. But what ended up happening was I was incorrect and the stock went down. So although I was okay only making $100 in 2 days, which is pretty great, I actually ended up making an additional $168 in credit to close the trade because the stock actually moved down into this profit zone. Instead of making this profit, which I was happy with, I was actually able to make this profit. So I returned a 7.5% return in just 2 days. Look at this annual compounded return, 56 million%. Yeah, thank you very much. This is why I love put ratio spreads, because when I'm right, I make money. And if I'm a little bit wrong, I make even more money. I'm absolutely loving trading these. If you liked today's video, if this was helpful in any way, shape, or form, give me a huge thumbs up. Click that like button down below and subscribe if you don't already so we can all get rich together. Thanks so much for watching and see you very soon.